4 of the Odyssey Pod. Today we are joined by Ethan from Ebisu. How are you doing, Ethan? And thanks a lot for joining.
Yeah, good. I'm doing good. Thanks for having me, Max.
Of course. So maybe let's start with a brief background, how you got into the space, what Ebisu is, for those not super active in the Liquidity and like broader fork ecosystem might not have heard of you. You guys are still pretty new on the block, but yeah, you've picked an interesting focus of chains and ecosystems. So yeah, let's start by giving the audience a brief intro.
For sure. I'm Ethan, one of the core contributors to Ebisu Finance. Um, Ebisu is a multi-chain CDP protocol. It lets users borrow the protocol's stablecoin EBUSD against our collateral at a fixed rate, user set fixed rate. So this lends itself well to yield-bearing stablecoin looping strategies, and then just like general dollar-denominated like borrowing. Um, yeah, you can think of it like a fixed rate variable duration loan, which is I think like a unique offering in DeFi. Um, yeah, we launched in the summer on Ethereum mainnet, and recently deployed on Plasma. And yeah, the collateral that we support is like all um, blue chip ETH or BTC derivatives and yield bearing stablecoins like Athena, CAP, USDAI, and Syrup. Um, yeah, before this, I was working in crypto since 2020. Um, I was like a venture scout at Draper Associates, which is like a Silicon Valley VC. Um, I led a crypto deal there in a company that I later worked at for 3 years. And at that company, I was like a BD for 1.5 years and then a product manager. And ended up building like an airdrop um, distribution tool that has gotten like pretty significant traction across the ecosystem today. Um, and yeah, throughout that process, have always been using DeFi. And in around 2023, decided to make the jump to leave that company and start Ebisu.
Nice. Just out of curiosity, what type of airdrop distribution tool were you building back then? Because back last year, that was also kind of something that I was working on with another company back then.
Yeah, it's called tokentable.xyz. Similar to like Liquify, Magna. Um, I think these tools is like kind of like a BD game, but this tool is now used by all of like the Binance Labs Accelerator portfolio companies. It was used by like Starknet, Zeta Chain, Kaito, Dogs, like a big airdrop, like the biggest airdrop on Ton. I don't know. It had pretty good adoption, but like the team I worked for had a pretty good BD team. I was mainly working on the product side, so it's more contract specs and then user experience, custom claiming dashboards, these kind of things. So it was more akin to like Web2 product management.
So it was less on the kind of product innovation, novel incentive mechanisms. It was more trying to kind of standardize the workflows behind airdrops and more of a BD game.
Yeah, exactly. Like what what do the projects want? What do the claimers want? And how can we build the best product for both of those users? And then user interviews, all that stuff. But yeah, those skills apply definitely in DeFi. But I think what helped more in DeFi was just being like an active user, active participant, and keeping track of like all the latest research.
Yeah. I also think that the airdrop landscape has changed quite significantly. I mean, the way airdrops were formed back in 2024 was much different before points became very mainstream, and it is now more people try to make napkin math calculations, and it's more or less a form and dump game. So yeah, I think that more and more projects will kind of reevaluate whether it's worth doing an airdrop or like try to attach it to metrics that are indicative of a more, let's say, sticky and loyal user behavior. I mean, on the other hand, it's very hard to build a crypto product that is actually worth using for the long run. So I think on the product side, we still have to innovate quite a bit, because while like technically they are very well working products and there's a bunch of them out there now, even compared to 2 or 3 years ago, there's still like basically the asymmetric return of DeFi and the incentive for most people to participate is subsidized by points speculation.
For
And
sure.
most of that is driven short to midterm. So, like, yeah,
No,
there has to be a constant influx of new games to play. Otherwise, most people will get bored. But yeah, how did you end up building a Liquidity V2 fork? I think I've seen a dashboard of Liquidity V2 forks, and there's like a dozen or 2 dozen out there. So it, on the surface, appears to be a quite crowded space. So
Mhm.
what edge did you see there, and how does Ebisu maybe differ a little bit from the other forks?
Yeah, so I think it piggybacks nicely off this points topic where initially we saw eigenlayer and restaking as one of like the first points programs, and we wanted to build a um, protocol for leveraged restaking farming. So the idea was that the points are going to pay off in the short run, and in the long run, these restaking layers will provide outsized yield to like ETH and BTC holders through and USD as well, holders through these like AVS rewards. We wanted to build like a leverage farming protocol specifically for restaking. Um, we saw like Prisma, which is like Liquidity V1 unfriendly fork, um, have some relative success before they got exploited in 2023, and then we kind of thought that like liquid restaking collateral is the next evolution. Um, Eventually, we realized like after studying a bit that the interest rate mechanism for Liquidity V1 is a bit broken. Like if you're always having like zero, if you have 0% interest loans, or if you even like Prisma, if you have or like My Finance or any of these stable coin CDPs that have a like team set interest rate, you have the issue of just like not having the proper rate based on the market conditions. People will mint and dump your stablecoin for other stablecoins to do like rate arbitrage, carry trade, and it's just not an good experience for borrowers if there's like constant depeg. And in liquidity mechanism, there's redemption, which is like in V1 was not pleasant for users. So we heard so yeah, after we started Ebisu, looking at this rate problem, we saw liquidity V2 was this like seemingly amazing solution to this problem of like how do you set the rate for a loan without the team intervening? Like how do you let the market participants decide what the cost of capital should be to borrow? It's not only looking at the protocol's internal health, but also looking at the prevailing rates across DeFi. And it's like without creating like a direct integration between all these protocols, how can you create a system that self-regulates rate? So Liquidity V2 provided a really elegant solution in the form of user set rates. And then since then, we've been working on the Liquidity V2 deployments as our first product. But I think you look at some other protocols who have used Liquidity V2 tech stack, like they're expanding to other stuff, and we have similar aspirations. Um, so that's the story. And one quick point is like we do think deeply about how can this protocol survive in the long run without like a token emission or some sort of point system. And I think the Liquidity V2 mechanism has a path towards that, which is why we've been like trying to build it as well. Like we saw that a clear path towards um, credit issuance at a fair market rate, or even I think in the end state, the liquidity V2 mechanism can provide a borrow rate lower than the prevailing market rate if the stablecoin is like having adoption outside of the system. So we can talk more about that. But yeah, I think in the long run, the goal is to create a protocol that you can sustainably borrow dollars against crypto at a rate that's cheaper than the market. I think that's like the goal for these kind of protocols.
Yeah, let's dive deeper into the resilience and the sustainability of the Liquidity and Ebisu model versus other borrowing lending, and maybe if you want to expand on DeFi at large, other protocols. So, what do you think that these other protocols are missing that is making a constant inflow of incentives, or just a general kind of asymmetric risk appetite a requirement for them to sustain, and where specifically does Liquidity or Ebisu offer incentives that are ingrained into the protocol itself and in the borrow lend relationship that do not require any external incentives, token incentive points programs for them to sustain?
For sure. Yeah. So the points meta has like been very like game theory optimized from the project perspective and the farmer perspective. And I think now it's relatively sophisticated where if you're building a chain, it's like very different than if you're building like if you're doing any sort of asset issuance versus if you're doing any sort of multi-stakeholder action like Ebisu or any other borrow lend protocols are. So um, I think for all of them in the early stage, you do need this token incentive because you're like it's kind of like CAC in Web 2, where you're paying for people to come in and put capital at risk. It's an untested, like non-Lindy protocol. There's smart contract risk, there's mechanism risk, there's team execution risk, liquidity risk, hidden risks. So you should be compensated for that. And it's not like airdropping for like a non-financial product where users are clicking buttons and getting tokens that way. But users are contributing to the system in the form of fees and whatnot. So you're kind of subsidizing that with the points and incentives. So I think it's valid. It's like valid and essential to start, especially in an environment where all your competitors are doing it. So um, yeah. So we are currently running some sort of a points program. It's called Ebisu, rewarding like borrowers, stability pool depositors, and DEX LPs to start. But um, I think there's this like hypothesis that was viral yesterday called like dead money thesis, where you only hold coin for two reasons. One, you have demand to hold this coin because it accrues cash flows from like economic value creation. So this is like hype. It's like burning back token from revenue, or this is like a bond that's like yielding you um, like some sort of tangible like inflow of money because you're giving a loan. Or you on the other side of the spectrum, you hold a coin because it's like money. It's like high velocity, deep liquidity, widely accepted. And there's two sides of the spectrum. You don't really want to be um, in the middle. And I think, yeah, to have success long term protocol, you need to like kind of position your product on one of the two sides of the spectrum. And where it gets tricky is if you're caught in the middle, and that's where like you're not offering some value prop that's deeply compelling to the market. So you have to constantly spend out of your pocket incentives to incentivize demand. So for us, we're trying to be, I think, on the side of the spectrum where um, the rates, the borrow rate. So we have two main users, which is like EBUSD holder, who generally seeks yield or like a decentralized stablecoin, and then a borrower who seeks like a cheap, sustainable rate. So our goal is to offer like both borrowers and earners, like EBOC holders, um, like the best rates that we possibly can, and like the system is designed to do that. So I guess I can get into the mechanism, but
Sure, sure.
um,
Let's dive deeper into that.
so it's a user set fixed rate.
Also, feel free to screen share if you want to walk the audience through the application.
Yeah, sure. Um, so yeah, it's a user set fixed rate variable duration loan. So it's a little bit a mouthful, but I think, yeah, it's a good idea to just walk through this and we can see. So this is like the borrow page. You can borrow against all these different collaterals. You're borrowing EBUSD against them. And yeah, what would that look like? So let's say I want to borrow, like I want to enter like a leverage looping position against SUSDE. So I would want to do this if like the SUSD yield is higher than the prevailing borrow rate on Ebisu. So what I can do is I can input the SUSDE collateral, choose how much debt I want to borrow against it, and here I'm setting my own interest rate. So um, whenever you think, oh, I can set my own rate, the first thought is like, why not set it to zero? So like we touched on earlier, if the protocol is issuing debt, like issuing the stablecoin at a like too much, meaning the rate is too low, the supply issuance is too high, it's going to lead to oversupply in the market, depegging the stablecoin. So we have a mechanism called redemption, where arbitrageurs can buy the stablecoin at a discount and redeem it for $1 worth of collateral, um, creating an incentive to buy the stablecoin whenever it's at a dpeg, pushing the peg back up.
So the implicit assumption there is that people will supply collateral, mint EBUSD against it, but then also they will sell or swap part of that EBUSD for other stuff to like continue DeFi farming with their loan. So that would essentially push EBUSD under peg, which then triggers the redemption mechanism, right? Or
Correct.
like where does the assumption come from that EBUSD would lose the peg in whatever scenario?
I see. So this example is about like, how can you let users set their own rate? Like, of course, the borrower has incentive to set it to 0. So what happens if everyone sets it to 0? Because the system allows that. How can this protocol survive if everyone is setting the rate towards like, so for stable coins, the minimum rate is 1.5, and then for non-dollar denominated assets, the minimum rate is 0.5. So if everyone sets minimum rate, what happens? The rate is too low, the issuance is too high, supply is greater than demand, because there's more people, there's more EBUSD in circulation versus like demand to actually buy it and hold it. So this redemption happens. It's DPEG is signaling to the protocol the rate is too low. Like people are not paying enough to issue this coin, and it's coming in circulation in too high of quantity. So redemption can be thought of like force constriction of the supply, because people come, they buy EBUSD, and then they redeem it, they burn it, reducing the supply, pushing the peg back up. And the redeemer gets $1 of collateral back. So if I bought it for 98 cents and I get $1 of collateral back, I'm profiting 2 cents. And on size, there's bots that do this all day. So how does this affect borrowers, and where does this collateral from redemption come from? So the collateral from redemption come from the borrower who pays the lowest rate. This means that, let's say I'm borrowing 1,000 EBUSD against my SUSDE. If I got redeemed, meaning like my rate was too low, let's say I got redeemed for 1,000 EBUSD worth. So 1,000 EBUSD depegged, someone bought it up, they redeemed. It would be as if my loan was forced repaid. So I didn't lose money. It's not like bad, like liquidation, but my debt would be canceled to 0 because I had 1,000 debt. It's now 0. But my collateral value, which let's say was 2,000, is reduced as well. So instead of having 2,000 worth of SUSDE to withdraw, I only have 1,000 because my debt was canceled proportionately. So it can be thought of like ADL.
They sell off their EBUSD to, for example, buy a Pendle PT. It's not that the Pendle PT or that like anything would disappear from their wallet, but essentially their collateral gets reduced relative to whatever value has been getting redeemed, right?
Correct. The collateral is reduced, and that debt that they previously had to repay, because like what they would do is they would wait till the Pendle maturity happens, they would unwind their Pendle position, and they would take some profit, but they would also, their principal would be needed to be swapped back to EBUSD to repay. But now they'd have no longer any obligation to repay. So it's not bad if you're borrowing against yield-bearing stablecoins. It's less pleasant if you're borrowing against like a ETH or gold or something that you want directional exposure to.
Yeah.
But still, you don't net you don't lose. It can be thought of like friendly ADL. Like system says, okay, your rate is too low, sir. Too much issuance is happening. We're gonna force repay your loan. You don't lose money, but now the average rate of the system rises because all of those loans that were at too low of a rate have now been slowly picked out, and then the system is able to come to equilibrium. Like what actually is the fair rate? And we have like I have like a chart that kind of goes
It would be really interesting to see any kinds of statistics or analytics of how the average rate changes by market sentiment and like over time, and like if there is an actual approximation of a fair rate in DeFi for fixed rate borrowing.
Yeah, like so the thing with Ebisu as well is you can change the rate anytime. So it's fixed rate, but you have like the ability to change, which is cool. I will. Yeah, if there is like, yeah, I can pull out something actually. Um, because I think right now like the prevailing reference rate is like either like the Sky borrow rate or like the Aave USD borrow rate. So I think that's mainly what we're arbed against. Like if someone is borrowing at like a 1% interest rate, like let's say Liquidity Bold, they're gonna sell the Bold for USD and farm like the 6% lending rate for USD on Aave, or like the 5 or 6% Sky savings rate. So that's kind of like the arb that happens. So I think everything's kind of trending towards like, that's where like the gravity is in the system. But like I mentioned earlier, like I'm gonna pull up a dashboard where um, there's like a block analytica borrow rate dashboard that basically shows that like Liquidity Bold is the cheapest place to borrow dollars against ETH sustainably, and it's because um, the peg of Bold is pretty good. There's deep DEX liquidity. There's some integrations across DeFi. The peg is strong, so users can afford. When the peg is strong, users can afford to set their rate lower than the prevailing rate and
Yeah.
not feel risk of being redeemed. So it's all about doing things to get your stablecoin adopted, pushing up the peg via like having some monetary premium, like demand to hold this coin as money, and that lets the borrowers enjoy a lower rate. And this is the kind of virtuous cycle of the system where this is a decentralized stablecoin. It's minted backed by a basket of assets. In the case of Bold, only ETH, very pristine. So if this asset can be widely adopted strictly for its monetary purposes, or for its yield from the stability pool, which we can get into, then borrowers can enjoy cheaper than prevailing rates.
So if
Um,
the rate becomes more attractive as the protocol TVL grows, why is there an incentive for that many forks of Liquidity? Shouldn't just on the surface, if people are listening to this now, shouldn't the understanding be that more or less everybody has an incentive to just use the biggest protocol of them all and not any of the new forks? Or is there anything in terms of novel mechanisms or novel incentives that the forks introduce?
for sure. So I think the main rationale for Liquidity for like having this fork thing is the Liquidity is the most forked protocol, and it's nice, like mainly for like new chains to have a way to natively issue stablecoin without paying for USDT, USDC, um, and also for having like supply sync for governance token. These have been like historic use cases for Liquidity V2 forks and Liquidity V1 forks. And for V2, they wanted some way for like the DAO or the token holders as well as the protocol, like Liquidity itself, to accrue some value from all of these forks. So that's why they created this licensing system where the intention is that every new chain or ecosystem can license their own fork, paying a percentage of the fork's token supply to Liquidity, mainly used to incentivize like Bold. And um, there's like exclusivity amongst collaterals per chain. So there's never going to be forks that are competitive with each other. You would go to one fork over another because you have money on one chain versus another. Or in the case of Ebisu, which is on mainnet, Liquidity is also on mainnet, we're offering like collateral that are not offered on Liquidity V2. And like we have made like significant modifications to the protocol to let us manage risk properly to match the needs of borrowers that like the we've identified like borrowers have needs of like um, wanting to borrow against these different kinds of collateral. And to enable that, we need some like Liquidity is famously immutable, but we need some mutability to allow for proper risk management. So yeah, that's kind of the the pitch for the forks. Like you look at Felix on Hyper EVM, it was one of the first stable coins on Hyper EVM before any fiat backed stable coin came, and they had tremendous success just enabling borrowing against hype. And it's like not really a market that Liquidity themselves would target.
No, no, that makes sense. Why do you think that in this case, Liquidity and its forks are not the largest issuer of stablecoins in DeFi? Like, shouldn't they, if everybody has an interest in like being able to borrow and mint at a very low rate, also the rate not being variable but fixed instead, shouldn't it be larger than, for example, Sky, or also maybe eat more into the market share of some of these centralized stables? Why do you think that these other ones are still quite dominant?
Mhm. Let me. Okay, I finally pulled up these tabs. I'll quickly share some stats, and then this is like a great question. But um, so here is the stats for borrow rate. Like you're gonna see, like bold is the lowest. This is stats for dollar borrow rates, stablecoin borrow rates across DeFi. So currently, like yeah, it's around 5% to borrow on Aave. Some more markets offer a bit cheaper, but then bold is the cheapest. So um, borrow rate is like a indication of supply of your stablecoin. Like if the borrow rate is low, you're going to get more minters, more supply. But then the other side is like if you have too much supply, it depegs. How can you maintain a low rate? It's if the peg is strong. Peg is strong come from demand to hold the stablecoin. So um, that's like that. Therein lies the problem of like why these protocols are still having trouble to grow. Like the whole pitch is like there's like these stability pools which earn 75% of the protocol's interest revenue as yield. So you can see on Ebisu, like we have some like we have some what do you call it, opportunities here because it's a relatively new protocol. Stability pools haven't got that much attention. So there's not much deposit. So that 75% of interest is actually amplified to like a pretty competitive APR. But um, that's just one source of demand. And um, like something like DAI or other stable coins. So let's first compare like with asset-backed stable coins. Something like DAI has like deep liquidity. There's a dead DAI supply, meaning like all this DAI that is like being held but forgotten about. Um, deep DEX liquidity, deep integrations, and then they have this like Spark, like and all these stars, which kind of act as like sub banks under the Fed bank, which let them do like liquidity provisioning, yield farming, and it's turned into like a whole treasury management game. Um, and this whole game is played essentially just to drive demand towards DAI or USDS and SUSDS. And I think these systems are all demand constrained. Like the rate is low, sure, anyone is down to mint. Um, but um, on the other side, is there someone for every minter? Is there someone willing to come and buy this coin and hold it for yield or hold it for monetary value? And I think the answer is uh, 99 cases out of 100, this demand is won by centralized stablecoin issuers because they're the ones who have the deep liquidity. They're the ones who have the SEX integrations. They're the ones who have um, maybe some sort of insurance or more like suitable towards like the general population's risk appetite. And it's also more capital efficient. Like the whole the whole limitation of like asset-backed stablecoins as a result of on-chain loan is that it has to be over collateralized. But if we're just talking about pure money use case, one-to-one stablecoin wins. So it's up to Liquidity and the forks, and DAI has Lindy, right? So it's, as a new protocol that just launched this year, it's up to you to create like this kind of incentive structure that creates demand to match the borrowing supply. Um, and yeah, that's a hard game. Liquidity's trying to solve it by having these forks. Like if you're gonna have all these 20 forks airdropping bold holders, that creates demand for bold. So um, so yeah, that's kind of a ramble, but it boils down to demand to hold your stable coin. This is like the constraint factor, and it really is a liquidity network effect.
Hmm.
Yeah.
Could you dive a little deeper into the differentiation between these pooled lending models that you see on Aave and Morpho and Euler? And yeah, feel free to also apply the differentiation on the sort of liquidity crisis DeFi has experienced last month. So, what are the advantages? What are the disadvantages? And how does the risk management and risk structure differ?
Yeah. So um, Ebisu, like other CDPs, is like a pooled lending model. Um, Pooled lending means that um, lenders are so there's a big pool of assets. Many different assets can be within this pool. these assets are used as collateral, and then lenders lending assets are borrowed by people who are posting collateral in this pool, and the risk is more socialized. So, um, as a lender, I don't really choose which asset I lend against. I just take one rate. I just take the rate that I'm given, and that rate is comprised of like based on the borrowing demand against all these different assets. In an isolated model, the market is more defined, more constrained, where only a specific types of collateral assets are supported, and a specific type of lender asset is supported, and the lender can choose which collateral they want to lend against. I think that's the main differentiations, like lender being exposed to a pool of assets versus a handful of assets,
Hmm.
and um, as a lender, like all of these money market systems rely on like lender as the first step, and I think they're like um, the yeah, one of the more like maybe the most important stakeholder in the system. So as a lender, you would choose to lend um, to an isolated market if you want to control what collaterals that you have exposure to. Typically, the lending rates are higher because um, in a pooled model, you have more capital being attracted to it, which can like push the rates down. But in an isolated model, if people are really demanding to borrow against a certain collateral, rates will be higher, leading to more yield for lenders. So that's why like we have seen the prevalence of Morpho, Euler, um, being like places where looping and borrowing against more exotic assets has taken off. Whereas on Aave, a pooled model, um, lenders may get lower rates, but it's like more set it and forget it. You always know there's going to be demand to borrow on Aave. You always know you're going to be earning some yield. You're not at the behest of like a curator to manage like allocating your capital to different isolated lending markets. So it's like set it, forget it. And as a borrower, you enjoy the benefit of um, cheaper interest rates as a function of more liquidity being lent towards this pool. And um, as a borrower, the downside is like you may not be able to borrow against that exotic collateral that you want to, because it's a pooled lending model, and the whoever's managing this market, again in the case of Aave, is doing it like only supporting like blue chip assets and supporting exotic assets with very low debt caps, because risk is socialized. So if a collateral goes bad, that bad debt is socialized amongst like all the lenders who lent against it, um, and it would just break the trust that the system is built upon. So Ebisu is similar, like EBUSD, which is like the asset that lenders quote unquote supply to the market by holding EBUSD. Um, is exposed to the risk of all the different collaterals. So yeah, it's a lending risk manager's job to parameterize these markets such that it's managing risk properly. So setting correct LTVs, setting correct debt caps. You don't want too much of the stablecoin to be backed by one asset. Um, Setting like parameters like minimum rate. We have all of these parameters mutable in Ebisu just so we can manage the rate properly, the risk properly, but made sure not to like make something. We made sure not to give like the administrative multi-sig control over things that it doesn't need to have control over from a risk standpoint. So it was a bit of a ramble, but that's kind of the differences how I see them.
Nice. Do you think that curators and like the whole risk curator vault type of people is Ebisu interesting for them to use? And could you imagine a path forward where they're also able to lend or like to borrow against the receipt tokens of their vault, as yeah, many of them did on Euler and Morpho?
Yeah. So um, I think there's two kinds. I'm gonna try to be more concise, but I think there's two kinds of curators. There's lending market curators like Aave Morpho, Euler Morpho, who have like an earn vault essentially. They do BD to attract deposits, let's say like USDC earn, and then they manage how much of this vault deposit they lend to BTC market, ETH market, PT market, and that's the role of the curator. It's like um, managing utilization and managing like, like taking into account utilization, risk, collateral risk, rate, interest rate, like lending rate, and then allocating their vault to these markets. That's one kind of curator. The other kind of curator is like a yield vault curator. So this is a curator who says, "Hey, deposit in my vault, and then we're going to earn you yield." Like this, like EtherFi Liquid, the Upshift vaults, the Midas vaults, the Stream Finances of the world. And this curator's job is to basically like it's like mini hedge fund. Um, and there's different vault protocols out there with different trade-offs, but like the ones that I like all like limit the power of the curator to like a specific set of whitelisted protocols. It's all very transparent. Like I think something like IPOR is very good in
Yeah,
this regard.
we just had Darren on the pod a few weeks ago.
Yeah, huge fan of what they're building. So Ebisu is more interesting to the second kind of curator, where if you're managing like we have two vaults live right now that are allocating to Ebisu Dex pools. So there's like a Lagoon vault by a community member, and then there's like an Upshift vault by ClearStar. So ClearStar is managing this Upshift vault. It allocates stablecoins across different um, stablecoin yield opportunities, and they've identified like EBUSD Dex pool to be one of them. So it helps us. We get DEX liquidity. It helps them. They get stablecoin dollar denominated yields. We're also launching our own vaults using IPOR soon that enable like leverage looping. So the curator for this vault is like Sentinel. It's like they're out of Impossible Finance. They're going to come to Ebisu to basically leverage up on yield bearing stablecoins like CAP at a cheap interest rate. So the way this vault work is it would be like instead of like a LP or like a EBUSD holder, it would be a borrower. It would be entering leverage looping position. Cap like STC USD earns 15%. Our borrow rate is 5%. So every loop you profit 10% carry. And then if the looping is like having too much size relative to the circulating supply of EBUSD, we're going to have a DPEG. And then in that case, that curator would, we have like a fallback mechanism to like loop on Morpho in the meantime while the EBUSD peg recovers. Morpho has like a 8% borrow rate on cap, so it's like 3% difference. So you're losing money more borrowing on Morpho, but Curator makes that decision to go to that fallback market. And once the peg is better at Ebisu, it reallocates towards the cheaper rate venue. So that's how curators, I imagine, mainly use us. It's like as a yield source, as a leverage source for cheap leverage. Curator vault tokens as collateral. Like, so our stance on collateral is like the collateral should be something that has the chance to be here in the next like 5-10 years. Um, we can remove collateral, but it's like a messy process. It leaves some tech debt. So we would rather support like things that are blue chip, which is why we haven't supported governance tokens or like super exotic yield bearing stablecoins, despite there being demand. But we do have this idea for like supporting PT tokens via a vault mechanism. So you would deposit in a vault, it would allocate to Athena PTs, it would auto roll over the PTs, and you would borrow against the vault. So
So maybe like an Infinify style type of collateral.
yeah, exactly like Infinify in the sense that for this kind of PT collateral, there should be some sort of duration trenching, because if you have like permissionless going in and out of the strategy, like it can result in like some losses through slippage. So or like getting out of the PT at the wrong time. So something like Infinify for sure is it's interesting, but yeah, it requires more hands-on management, which is why that this would be wrapped into a vault. The collateral would not be the naked PT, but it would be a vault.
Hmm. Maybe to pivot topics a little bit. So
Mhm.
there is a bunch of chains you could have chosen to launch on. There's of course Eve mainnet, Base is quite relevant. Arbitrum is still around. Of course, you have all of the other L2s, but they have declined a bit in differentiators and activities over the past 12 to 18 months. And you picked Plasma. So Plasma launched, I think it was 2 months ago, roughly, and had a bunch of kind of pre-TVL commitments, etc. Was very hyped because of the association with Tether. I've personally also tried to farm it quite a bit and been cheering towards Plasma being successful. But as of now, it seems like it is struggling to pick a differentiator versus other chains. Maybe embark on somewhat of a like different similar decline as many of the old L1s in 2021 and 2022 after they probably had their peak before or around the Luna UST collapse. We've also seen Berachain launch earlier this year, which also has not succeeded in attracting or like retaining all the TVL it got beforehand. So why Plasma? Feel free to shill your Plasma bull case or like any opinion you have on the broader ecosystem there.
For sure. Yeah, like CT have like, so first of all, we heard about Plasma like before the summer. We were compelled by it. We deployed on Ethereum first, and we saw that there was a good growth. There's like Ethereum's the biggest market, but it's not a market where you're going to get any kind of boost in demand from like external incentives and or hype. So we wanted to deploy on a wanted to test how the protocol would perform on a chain where there can be like external incentives, hype, this kind of thing. So that was our rationale for deploying on Plasma, part of it. And yes, like CT have like a memory of like a 2-day weighted average. It's like, what's the sentiment from the last 2 days? And then if it's trending bad, I'm gonna be mad. If it's trending good, I'm gonna be happy. And I do think like the Plasma, I've gotten burned on like perps on the XPL tokens. I definitely feel you there.
Yeah, I also bought it the spot and like I'm down very bad on it.
Yeah. So, but I think the team is pretty competent. So here's my bull case as like a builder in that ecosystem. So stablecoin chain. Like I think there's two main like value props or bull cases for like stablecoin chains. It's like one, proximity to payment flows, and then two, net new stablecoin DeFi. So what does each of those mean? Like payment flows is like if you can be the chain that attracts like the Tron killer thesis essentially. If you can be the chain that attracts all this velocity of money through payments, it's going to be good to build. Like whenever you have payments, you need credit facilities in parallel, like in proximity to it. You need asset issuance in parallel to it. I think that's the whole neobank thesis. If you can get everyone to like pay on your platform, then you can upsell them with all these different complementary products, and that's the whole neobank thesis. And like Plasma's infrastructure lends itself towards proximity to payment flows. And I think you can see they're already like the top chain for sex to sex stablecoin transfer because it's like zero fee USDT transfer plus like deep stablecoin liquidity. So that's the first thing. And the second thing is stablecoin DeFi. We've seen emergence of like this new kind of stablecoin started by Athena, where it basically takes money and goes and does an arbitrary off-chain trade. It's like kind of like a hedge fund with like a very defined strategy, and it's up to the protocol to build all these transparency tooling that like lets people be able to underwrite the risk of this off-chain strategy properly. We see things like USDAI, Daylight, doing this for private credit, so sourcing stablecoin deposits as like a cheap source, as a source of lender liquidity with a lower cost of capital, and then deploying it into like lucrative off-chain credit vehicles and passing the yield back to the stablecoin holder. So if you're like a new stablecoin innovator and you want to launch on a chain, I think it's attractive to go to a chain that already has like deep stablecoin liquidity, because what's enabled by like tokenizing something in a dollar denominated form is like looping. This is something we don't really have direct comparison to in TradFi. And for looping, you want to be on a chain with deep liquidity. So I think this ties back to XPL price. How? I think Plasma did really good go-to-market, and they were able to have successful go-to-market because they did like all this hype around Plasma token. It launched at a high FDV, and they were able to use the token emissions at the high FDV for like very successful liquidity mining campaign. They still have some incentives, but the incentives have tapered. But if you look at across DeFi there, it's very healthy in some regards. There's a lot of liquidity on DEXs for stablecoin swaps, and there's a lot of lender liquidity on different lending markets like Aave, Fluid,
Yeah, I think
Euler.
like more than 1 billion in some of the Aave pools. I think it was particularly driven by the kind of levering up Ethena, USDE, and SUSDE trade. So like I think it's to be seen how sticky this liquidity is going to be. But I mean, directionally, I very much agree. Plasma definitely has differentiators in terms of their backers and who they are associated with. And if they're successful in creating more of these DeFi native or like natively DeFi integrated stablecoin payment flows, I do think that they have quite a bright future ahead, or that at least they are much more interesting than some other ones. I think on the being integrated into fintech and like traditional finance payment flows, the other one that is also seemingly associated with Tether, I think it's called Stable. It
Mhm.
seems to be a little stronger on the BD side there. I think it was like mid-October, early November when there have been a couple of announcements of like fintechs partnering up with them. So while the bear case I would see is that by now most chains have collapsed down into becoming stablecoin chains. I mean, Ethereum and Solana are the only exceptions because on Solana you still have like more long tail speculation on memes and just like a more kind of yeah risk curious community of holders. And both ETH and Solana are the only two, let's say, L1 assets that have at least been able to sustain some sort of monetary premium over the years. Also,
Mhm.
with ETH, that is obviously on a much larger scale than for Solana because they have a much more established holder base where many people view ETH as the proxy bet on just the adoption of crypto technology at large. So, yeah, I'm curious just to see how that is going to go forward.
Yeah. If we look, like, institutions are tokenizing on Ethereum. Ethereum's like the most credibly neutral, bulletproof chain. But I do see the case for having a chain that's new to go and actively do BD to like get um, specific kind of asset issuer to come on their chain. So I think Plasma's focused on this private credit kind of asset.
Mm,
Like if you look at their like you said, they bootstrap their Aave through the SUSDE and USD Athena PT looping stuff. Um, but I think they're going to continue to push forward on this like S Syrup USD, USDAI, Daylight USD kind of thing.
mm,
And um, like if you look at their like Plasma deployment of Aave, the borrow rate is lower than on mainnet, but lenders are having like high elasticity where like they're willing to lend wherever the rate is highest, but borrowers have low elasticity. So even though the rate is cheaper, you have seen like slowly borrowers coming and migrating over. So I think the success of these kind of new chains relies on them, one, having new assets coming to be issued natively there, and then offering leverage against those assets like more exclusively. So Syrup USDT, I don't think it's listed on Aave mainnet, but it's on Plasma. And then this is
mm.
like some borrowing demand that doesn't have to be stolen from anywhere, but it
Yeah.
can be like natively created on this chain. And the lending rate is still incentivized with XPL. So how do we get to a sustainable state? I think it comes from this neobank narrative. Like you need new liquidity in the system. So in Plasma, I think they're focusing more on like emerging markets and like with their like Plasma One neobank product. And if you have new liquidity coming in for payments through like a neobank, through like because of there's like economic incentive like no fees and then cashback 4%, then you can upsell them yield products. That means you have like net new depositors minting these kind of like probably through a vault minting an assortment of these different stable coins, and that's going to be bringing like a new supply of stable coins to the chain. um, and then maybe they're going to be like some managed looping strategies or even just like lending towards Aave. So like if there's like a neobank vault that lends to Aave, then that now like a crypto native or sophisticated actor who's interested in one of these new private credit stablecoins only on Plasma has like cheap liquidity to borrow against. So that's like how I view like them growing out of this initial bootstrapping phase into like a sustainable phase of like you can really attract real users who are going to put money into this neobank product that lends towards all of DeFi and creating sustainably lower rates and favorable environment for like sophisticated actors. But there's a lot of contingencies that this plan relies on, and obviously, like you mentioned, there's a lot of competitors. I think Stable is like targeting more U.S. institution and like JP Morgan stablecoin. All of these chains, all of these institutions are going to have stablecoins. Stable is targeting that, integrating into payment processors, payment service providers. So it's a different approach. And then we have like Klarna. I don't know if you saw yesterday, have this like stablecoin on uh, Arc. So which is by Stripe. So it's super competitive. But I think Plasma's angle is retail. Well, let's see how it goes.
Yeah, I think the neobank angle is quite interesting. I mean, it's not without competition. I think EtherFi is sort of leading the charge there right now on the application layer, and I think they are doing quite a good job. We had them on the pod. I think it was in August or September, and I mean, Mantle also trying to compete. I mean, they have the advantage of like an existing distribution funnel associated with Bybit, the centralized exchange. But I think for the like, if you want to be on a chain level and like deeply integrated into DeFi, I think yeah, it's probably EtherFi or Plasma that you're eyeing right now. But yeah, are there any like plans for the rest of 2025 in terms of feature launch, what your current growth strategy is looking like? I mean, you're still very early stage, so like you have, I mean, you still have the challenge of establishing yourself, but you also have the opportunity to view things more from a blank slate. So how do you target growth right now, and yeah, what are the plans for the months coming forward?
Yes. So first priority is like growing EBUSD DEX liquidity. We had like a pretty big outflows over the last month, so we're trying to get those the DEX liquidity deeper. This is the first priority because we talked about earlier. Borrowers only have like a nice time if the peg is strong, liquidity is thick. So we are doing like the curve convex bribing, um, similarly on Plasma, just yeah, opening pools on different dexes to basically just grow liquidity, incentivize it with points, incentivize it with cash bribes, incentivize it with um, through liquid, like working with liquidity partners. Second step is once we have liquidity, like other growth levers, like adding new collateral, creating vaults that do managed looping strategies, like one-click looping of like cap STC USD, for example, making EBUSD cross-chain through layer 0. These are all things that we have ready to ship that are going to have more impact on growth once there's deeper liquidity. So that's mainly the plan. And I think it's like a virtuous flywheel in the sense that like 25% of our protocol revenue goes towards DEX liquidity. So the more borrowers there are paying like a fair interest rate, the more money we have to incentivize DEX liquidity, and it grows like favorably. So the hope is that like as we continue to add more collateral that we deem to be blue chip, but also having like high demand from the market, something like neutral I think is interesting. Daylight when they launch the Klarna stablecoin, even if it's on another chain and providing it fits the risk framework, that should bring borrower demand, which lets the protocol generate interest, which lets us throw more revenue back at EBUSD to incentivize that demand. So this is like the flywheel that I see, but yeah, we're still very much so in the initial bootstrapping phases.
Very nice. We're about to hit the hour, so are there any last comments you'd like to make, or where can people find you and follow Ebisu, or yeah, any shout out?
Yeah, I think yeah, we covered a lot. Overall, very like optimistic towards the next year of DeFi. Um, TradFi and institutions and sophisticated capital is obviously coming on chain, and more sophisticated protocols that's are built to service their needs are coming live on the asset issuer side. I think I'm very excited about the private credit stuff. Um, and vault management curation is getting more sophisticated. And then legacy DeFi is also upgrading. Like we're seeing Morpho V2, Fluid V2, Pendle Boros, Aave V4. So much like of the incumbents also upgrading. So I think it's a very interesting time for DeFi. Um, yeah, I think we're going to continue to try to like play our part in that. So you can follow Ebisu on Twitter, And then my Twitter is like Ebisu Ethan. But yeah, I thank you, Max, for having me today.
Of course, I think that was a very nice and optimistic point to end on. So thanks again for coming on, and yeah, make sure to check out Ebisu, especially if you're actively forming plasma, which I think quite a few in the audience are still doing.
Yeah, thanks.
Have a good one.